Now we're going to talk about inventory. Inventory is a very interesting area. Not as prevalent in Silicon Valley, but it does exist in quite a few companies, and so it's worth understanding. So the the cycle can be thought of in a couple different ways. The physical flow of the actual goods and the related costs. So if something goes through a production cycle, you're going to have labor and materials added to it, and then some element of overhead. This goes back to your hopefully your cost accounting class. And as there's significant judgment in those elements, there's a lot of potential for fraud. So, in Dell, Dell was getting payments from Intel as a supplier, and basically recording those payments to income when they should have been in inventory. And then also, they were maintaining reserves and increasing the reserves in good years, and then drawing down the reserves in bad years to offset bad years. So Dell has had some inventory misstatements along the way. Um, Rite Aid is pretty famous fraud. They again, like other like Crazy Eddie, they would play around with stores where they knew the auditors weren't going. They would construct bogus vendor rebates. They would tell the vendors that they had bought more stuff than they had and get vendor rebates. They'd adjust gross profit. They get payments for prescriptions that they hadn't filled. And they'd adjust inventory shrinkage, right? So there's a myriad of inventory fraud going back to McKesson. This is an area where you really need to understand the business, and then in understanding the business, you're going to understand the accounting implications, right? So um, the types of things that we see in Silicon Valley nowadays, excluding companies like Tesla, are situations where you're dealing with contract manufacturers or third-party manufacturers that you work with, and that you give them the design, and they actually build the product. So, Apple doesn't have a lot of inventory on its books. Why? Because, Foxconn and other manufacturers do the actual production for them under Apple's direction. But, they're not Apple inventory unless Apple's buying specific components and then transporting them to Foxconn to use the materials, or in if Apple's actually producing the items, right? But it's very low inventory balances because they're using a third-party manufacturer. The things again, if you've been in cost accounting or in any manufacturing accounting class, kind of these things is you create a purchase order, you receive raw materials, and then you store them, and then you put them into production, and those go from raw materials to work in progress to finished goods. Work in progress, is the toughest thing to audit, right? Because you need to understand where it is in the stage of production and what things have been added to it and what things haven't. And obviously, when you're doing a physical inventory count, production needs to stop, and that can be a real challenge. There's a bunch of different considerations in inventory accounting, but it all starts with raw materials, right? Um, so back in the day, and even in small companies, you could have periodic inventory systems where basically people would count inventory at the end of each month, and then record the difference, the change in inventory, as cost of goods, right? Because essentially your sales minus your purchases would get you your adjusted inventory, right? And so by having a net adjustment, you have if your inventory increased, it's because you purchased more items, but then you took out a portion of those items in cost of goods, so you're able to make that entry. Nowadays, because of technology, almost every place is going to be doing perpetual inventory. I mean, like even in QuickBooks, we maintain a perpetual inventory. It's a lot easier, and you can check it at any point in time. So I don't think nobody who's going to pay for an audit, in my opinion, is going to have a periodic inventory system. So at any point in time, you should be able to get a list of inventory. And that helps from a management perspective too. This is not just about accounting. This is actually about managing inventory flows and keeping your costs under control. So you can see all the flows in the T accounts. I'm not going to go through this, but the inventory audit is really about how you acquire and record new materials, whether it's raw materials or finished goods, and how you allocate labor and overhead, right? And then what costs get transferred over um, into inventory, and then ultimately you ship the goods, you record revenue, and you record costs. Um, you also physically observe the inventory. That's a requirement. Recommending confirmation of accounts receivable is recommended but not required, presumed but not required. Inventory observation is required because of the McKesson situation. And then inventory pricing, right? Lower of cost or market. Um, so you can see the flow of materials into storage. You issue materials into production. You go through production, and then you add up all the costs of that production, and you allocate it to each inventory item. You put them into storage, and then you ship them. Okay. Um, so again, you look at the cycles where you've tested elements of this. So the acquisition, payment, and payroll cycles we've already tested. We've gone through these in the prior chapters. So this chapter, the internal transfer and asset costs, sales and collections is ship goods and record revenue and cost. And then this chapter, physically observe and pricing. So cost accounting systems. Again, um, back in the day, there used to be what were called standard costing systems. And standard costing systems were designed to make it easier to account for individual items and assign a cost to them based on what you expected standards to be. And you would get variances based on rate and volume when production was inefficient or extremely efficient, right? You would produce less or more, and that would impact the actual cost. But because you had set standard costs, you record those things at standard and then determine whether the variances should be in inventory or should be flowing through costs. Now, it's a lot easier, again, just like perpetual inventory, it's a lot easier to capture and allocate actual costs to each production run. So people tend to do that. I think in semiconductor companies and stuff like that, you probably still see standard costing models, but I think in a lot of companies now, you can uh, you can use actual costing models. Um, the processes affecting your physical inventory are how you count, how you control raw materials, work in process, and finished goods, right? And then how you allocate costs into each of those. Um, so the auditor is concerned with how do you maintain control over the inventory, right? What security and physical access do you have to it? How do you track inventory? Usually, QR code or barcode now is a very easy way to know exactly where something is. It's almost like FedEx, right? FedEx knows exactly where your package is. And, if you've ever had the good fortune to tour the Tesla factory, that's probably the best production thing you can do. So I'd encourage you, if you can get the opportunity, to tour it, because they're actually making cars in Fremont, California. Excuse me, and you can see it, right? And you can see stuff being added to production, but the labor component of it is very limited. Most of it is automated, most of it's robotic. People are there to help load materials and to monitor. Um, so it's very, very interesting, can give you a real picture of these kinds of things. So hopefully one of you gets to be on the audit team for Tesla and see all this. So watch the tracking of all those things, and then the master files and the cost records, right? Analytical procedures, again, are extremely important in inventory, right? You can look at gross margins, you can look at the relative balances of accounts, you can look at purchase volume, and you can look at non-financial information, right? Because that is, that those attributes can really help. So, inventory is often a large asset. Um, Again, if you're in production, fixed assets may be very big as well, but it is definitely, excuse me, so the largest current asset in the financial statements. And you can use a lot of technology tools to be very efficient in the audit of inventory. Um, so, from an analytical perspective, gross margin analysis, turnover, unit cost, um, and testing extended inventory value based on using computer assisted audit techniques, what your manufacturing costs are, all those kinds of things. So again, we've talked in both Kleichman and in class about the McKesson and Robbins case, and I can't emphasize this enough. We learn the lessons as a profession of our past sins, and McKesson generated the requirement to physically observe inventory. So don't make any New Year's plans for New Year's 2021 or 2022, because you're going to be sitting in a warehouse observing physical inventory if you're in a public accounting firm. Hopefully, we're at that point where we can physically observe inventory. It's going to be a challenge for auditors this year to physically observe inventory, and they're going to have to come up with some creative solutions. But you are required to physically observe the inventory. So the client takes the physical inventory and you test it, right? So there's a combination of observing controls and observing actual counting and then doing your own counts. But it all starts with an understanding of the business, an understanding of the controls, and the planning and preparation that's gone into the inventory observation. The better planned it is, the less the downtime is from keeping production going, because you're not going to audit a moving target, if hopefully. In some cases, you have to, because if you shut down a production line, it can cause the production systems to crash, and a yield loss of all the material in the production line. So this goes for disks and disk drives and things like that. A lot of it is planning and understanding what the process is from a manufacturing standpoint, and then designing your inventory test around that. You take a tour, you look at all the receiving and shipping areas, and you understand how they're actually going to conduct the inventory. Um, so the auditing standards require um, the auditor to be present at the time the client counts its inventory, observe their procedures, uh, ask the client about their procedures, and then do their own independent tests of the counts. But this is where you've got to not allow the client to know which items you're going to count, because if you give them a list of what you're going to count, then they're not going to make any mistakes on those. So you need to conduct counts that are selected by you, not uh, um, tipping off the client, and then perhaps picking a few extra uh, items to just count above and beyond, just to keep the client on their toes, right? Um, um, Adequate control over the physical count includes, instructions, but not only instructions, but sessions to prepare the client personnel who will be doing the count to know what's good and what's not, right? There has to be supervision, both of company personnel, but also the audit team, right? I, as a manager, would go out to my clients' physical inventories to make sure that the count was being done correctly by our team, because we only get one shot to get it right, right? I mean, it's not only the client, but we're not going to ask the client to stop production again because we screwed up the inventory count, right? Um, you want to see that the client has people doing their own tests before you test, right? So they've got a procedure to double check some of the internal counts. And then, reconciliation and documentation of reconciliation between the physical count the client ended up with and what was in the accounting records, and understanding those differences and how those differences may have resulted, because that also goes to management of the business, right? If you've got the wrong inventory balances, you're not going to really know what you have and what you need to acquire, and you're not efficient, right? It's like when you look something up and it looks like it's available at Home Depot, and then you get there and it's not, right? That's very frustrating. And the same thing happens when you're trying to sell a product, and you look in your inventory and you've got it, but then you go to the shelf and it's not there, right? That's very, very irritating as a business person. So these kinds of things can help operationally as well as from an audit perspective. And then pricing. You know, you've got to make sure that the value that the inventory is carried at is appropriate. So it should be a cost, but it is the lower cost or market. And so you want to understand where all the inputs are into the cost process and be able to test each of those, right? So if there are 3 stages in work in progress, and at each stage there's payroll added and overhead added and some materials, you want to be able to test all 3 of those stages. Um, and then you want to understand the internal controls, because that will reduce the amount of items that you have to go through and test for pricing. Um, in the method has to be in accordance with accounting standards, of course, but it must be also consistent from year to year. You can't change your inventory methodology every year based on what the numbers you want to see versus what the real numbers are, right? And you are required to carry inventory at the lower cost or market. And market is whatever you can sell it at minus selling costs. So if you're not going to be able to sell your inventory above cost, then you have to quote market to market, right? And so, you know, that does happen. You know, prices drop in technology very quickly. And so, you know, last year's model of something can actually go below the cost. And the company's just trying to sell last year's model to get rid of it. And they might sell it at a loss. Uh, and that's okay because they're at least getting some money for it, because the value continues to decline as technology improves. Um, so, you know, all these tests kind of work together, right? The payment cycle, the payroll cycle, sales and collection, all work to give you information about inventory. And then in the inventory section, you're actually testing the cost accounting, how materials and people time, etc., are added into the process and into cost. And then, you know, looking at pricing and the physical goods themselves. Okay, so and now we're on to chapter 22.